On April 15th, gold hit an all-time high above $3,200. 2 days later, without a single war, without a pandemic headline, without a Federal Reserve announcement, gold dropped over $100 in less than 72 hours. This wasn't a pullback. This wasn't profit-taking. This was a coordinated pressure event. And if you understand how the gold market actually works, you know that price didn't fall because sellers overwhelmed buyers. It fell because someone wanted it to fall. No major headline, no fundamental shift, just a violent move that liquidated billions in leveraged long positions and convinced retail investors that the rally was over. But here's what didn't happen. Physical gold didn't suddenly flood the market. Central banks didn't dump their reserves. Mining output didn't spike. So why did the price collapse? By the end of this video, you'll understand exactly who benefits from suppressing gold, how the mechanism works in plain English, and why this same pattern has repeated at every critical moment in gold's modern history. This is Jack Goldsman. Welcome to the Hidden Economy. If you're new here, this channel exists to show you what's happening behind the price. Not the story they tell you, the story they don't want you to see. Subscribe now. Not because I'm asking nicely, because what you're about to learn will change how you look at every gold chart for the rest of your life. Hit the bell so you don't miss the next investigation. Share this with one person who panicked when gold dropped last week. And let me be clear from the start, this is not financial advice. I'm not telling you to buy, sell, or hold anything. I'm showing you a mechanism. What you do with that information is your decision. Let me walk you through what actually happened in that 72-hour window, because timing is everything when you're trying to understand market manipulation. On Tuesday morning, gold was trading near its record high. Asian markets were bullish. Physical demand from China and India remained elevated. Central banks, particularly those outside the Western Alliance, were still accumulating. The fundamental picture hadn't changed. Then, during the thin liquidity window between the London close and the New York open, a wave of selling hit the COMEX futures market. Not physical selling, paper selling. Contracts representing gold that may or may not exist in vaults were dumped in quantities that no rational seller would execute if they wanted the best price. This is the first tell. When someone sells a massive position in a low liquidity window and drives the price against themselves, they're not trying to exit a trade. They're trying to move the price. By Wednesday afternoon, the damage was done. Margin calls triggered across the futures complex. Leveraged longs, retail traders, small funds, momentum players were forced to liquidate. Stop losses cascaded. The price dropped another $50. By Thursday morning, sentiment had flipped entirely. The same analysts who were calling for $4,000 gold were now warning of a deeper correction. But here's what didn't change: the physical market. Premiums on gold coins actually increased during this period. Delivery times extended. Central bank buying continued uninterrupted. The screen said gold was crashing. Reality said something very different. So how does this work? How can the price of gold fall when physical demand remains strong? The answer is that you're not looking at the price of gold. You're looking at the price of paper promises that claim to represent gold. Let me explain this in the simplest terms possible. The gold price you see quoted on CNBC, on your trading app, on financial websites, that price is set by futures contracts traded on the COMEX exchange in New York and the LBMA system in London. These are derivatives. They're not gold. They're bets on where gold will be at some future date. And here's the critical part. The volume of these paper contracts vastly exceeds the amount of physical gold available for delivery. Estimates vary, but credible analyses suggest that for every ounce of physical gold in COMEX vaults, there may be anywhere from 50 to 200 ounces worth of paper claims. This is not controversial. This is how the market is structured. Now think about what this means. If you can control the paper market, if you can flood it with sell orders at strategic moments, you can move the price without ever touching a single physical ounce. You're not selling gold, you're selling the illusion of gold. And when the price drops, everyone who holds physical gold sees their net worth decline on paper, even though nothing has changed about the metal sitting in their safe. This is the mechanism. Paper drives price. Physical drives value. And the two can diverge, sometimes dramatically, before eventually converging. But here's the part they don't teach you in finance class. Who controls the paper? That's where this gets interesting. The COMEX futures market is dominated by a handful of large commercial banks. Public data from the Commodity Futures Trading Commission, the COT reports, shows that a small number of institutions consistently hold massive concentrated short positions in gold futures. When they need to, they can dump contracts into the market and trigger exactly the kind of cascade we saw last week. This isn't speculation, this is what the data shows. Now, why would banks want to suppress the gold price? One plausible explanation, and I want to be careful here because I'm not accusing anyone of crimes, is that a rising gold price is a vote of no confidence in the financial system. Gold competes with treasury bonds. Gold competes with the dollar. When gold rises, it signals that people are losing faith in paper currencies and the institutions that issue them. There's a reason central banks have been accumulating gold at record rates while publicly dismissing its importance. They know what it represents. And there's a reason the price keeps getting slammed at technically significant moments, during low liquidity windows, in ways that maximize damage to leveraged longs. You don't fight this hard against something that doesn't matter. Look at what's happened to registered gold, the metal actually available for delivery, over the past 3 years. It has declined significantly, while the paper open interest has remained elevated. This is the divergence I'm talking about. More claims chasing less metal. The ratio is getting more extreme, not less. These are the banks. Look at when those positions increase, right before price drops. Look at when they decrease, right after the damage is done. The pattern is consistent enough that multiple academic studies have flagged it as anomalous. One study from a European university, I'll put the citation on screen, found that the concentration of short positions in gold futures was statistically significant and correlated with subsequent price declines. During last week's paper price collapse, what happened to the premium you pay for a physical gold coin versus the spot price? It went up. That's the market telling you that real gold, the metal you can hold in your hand, is more valuable than the paper price suggests. This divergence has been widening for years, and it's particularly pronounced during periods of stress. Central banks, particularly China, Russia, Turkey, India, Poland, have been buying gold at multi-decade highs. According to the World Gold Council, central bank purchases in 2022 and 2023 reached levels not seen since the 1960s. And here's the key question. If gold is just a barbarous relic with no monetary significance, why are the institutions that print money buying it as fast as they can? The answer is obvious. They know the paper system is fragile. They know the dollar's reserve status is being questioned. They're hedging their bets. And they'd prefer it if you didn't do the same. Gold's biggest one-day percentage declines have a pattern. They often occur during Asian market holidays when liquidity is thin. They often occur right before major options expiration dates. They often occur after gold breaks through significant technical resistance, drawing in momentum buyers who are then liquidated. Once is an accident, twice is a coincidence. How many times does the pattern have to repeat before we're allowed to call it a pattern? This isn't the first time this has happened. Let me take you back to 2011. Gold had been rising for a decade. It was approaching $1,900, an all-time high at the time. Central banks were printing money in response to the European debt crisis. Inflation concerns were rising. Every fundamental pointed higher. Then, in September 2011, the CME raised margin requirements for gold futures, not once but multiple times in rapid succession. The effect was immediate. Leveraged longs were forced out. The price dropped hundreds of dollars in weeks. Gold wouldn't return to those highs for nearly a decade. Fast forward to March 2020. The pandemic hits. Safe haven demand explodes. Gold should rally. And initially, it does. But then, something strange happens. In mid-March, gold drops sharply, even as the stock market is crashing, even as the Fed is preparing unprecedented stimulus. Why? Liquidity. Margin calls across the entire financial system forced hedge funds to sell everything, including gold, to raise cash. The paper price collapsed while physical gold became nearly impossible to buy at any price. Premiums exploded. Coin dealers sold out. The U.S. Mint reported record demand. The screen said one thing. Reality said another. And go back further, to 2008. During the financial crisis, gold initially dropped with everything else as deleveraging swept through the system. Paper gold was liquidated, but physical gold held firm, and within months, gold began a rally that would last years and culminate in that 2011 peak. The lesson is always the same. In a liquidity crisis, paper gets sold, physical gets hoarded, and the screen price temporarily disconnects from reality. Now look at today. We're seeing the same pattern: record central bank buying, declining COMEX inventories, widening physical premiums, concentrated short positions in the paper market, and violent price drops at technically significant moments. The mechanism isn't new. The players aren't new. The question is, how much longer the gap between paper and physical can persist before something breaks? I know some of you watching this are scared. You bought gold near the highs, you saw the price drop, and now you're wondering if you made a mistake. I understand. That's exactly how you're supposed to feel. That's the point of these price raids, to shake out weak hands, to make you doubt your conviction, to get you to sell your physical gold to someone else who understands its value better than you do. And I'm not here to tell you whether to buy, sell, or hold. This is not financial advice. That's the second time I've said it, and I mean it. I don't know your financial situation, your risk tolerance, or your time horizon, but I can tell you what I see. I see a viewer who's scared, who bought gold because they heard it was a safe haven, and now they're watching their portfolio decline and wondering what went wrong. For you, I'd say this: understand the difference between paper and physical. If you own physical gold, coins, bars, metal in a vault you control, the number on your screen is not your net worth. It's a fiction determined by derivatives traders in New York. Your gold still exists. It still has the same atomic weight. It still represents thousands of years of monetary history. The screen will catch up to reality eventually. I see a second viewer who's confused, who doesn't own gold but is watching this video because something feels wrong about the financial system and they're trying to understand. For you, I'd say this: trust your instincts. The fact that you're here means you sense that the official narrative doesn't match what you're seeing. Keep learning. Understand how the system actually works. And when you're ready, make decisions based on your own analysis, not on what the screen tells you. And I see a third viewer who already understands, who knows about paper versus physical, who has been accumulating on dips, who sees these price drops as opportunities rather than threats. For you, I'd say this: the game isn't over. The tension between the paper market and physical reality has been building for years. Something will eventually give. I don't know when. I don't know what the catalyst will be. But I know that systems under tension don't stay stable forever. For all of you, I'll say this: risk management matters. Don't bet more than you can afford to lose. Don't use leverage in a market that can be moved against you overnight. Own physical metal if you can. Understand that timing is impossible to predict. And remember that the people who control the paper market have resources and information you don't have. This is not a fair fight. It never has been. So where does this leave us? We've seen the mechanism, how paper contracts that outnumber physical gold by orders of magnitude can move the price without any corresponding change in supply or demand for the actual metal. We've seen the evidence: declining COMEX inventories, concentrated short positions, widening physical premiums, record central bank buying. We've seen the pattern, the same playbook used in 2008, in 2011, in 2020, and again today. They call it volatility. They call it market forces. They call it price discovery. I call it the system showing you its hand. The real price of gold is not on your screen. The real price is whatever someone is willing to pay for physical metal when the paper market freezes, when the ETFs stop trading, when the banks close the delivery window. That price is higher than what you see today. How much higher? I don't know. But I know this: you don't suppress something that doesn't matter. You don't fight this hard against something that poses no threat. The very existence of this mechanism tells you everything you need to know about what gold represents to the people who run the system. So let me ask you directly, after what you've seen, after the timeline, after the mechanism, after the evidence, after the pattern, what are you going to do? Are you holding? Are you selling? Are you waiting for lower prices to accumulate? Drop your answer in the comments. Not because I'm curious, though I am, because this community learns from each other. When you share your thinking, you help someone else who's struggling with the same questions. Subscribe if you haven't already, hit the bell so you don't miss the next investigation, and share this video with one person, just one, who panicked during last week's drop and sold their gold at the worst possible moment. Maybe they'll see what you just saw. Maybe they'll understand. The hidden economy isn't hidden anymore, not if you know where to look.